All right. Hello, everyone. I'm going to take a look at the market here. The market's been pretty easy to read. I'm not surprised at all that this this sell-off is happening. I think it's going to continue to go, and I'll tell you why. So my name's Mark. I'm the stock market jobber, former hedge fund trader, former market manager, blah, 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 yay me. Let's just say I've been around the block a few times. So I picked up a few things along the way. Now, different things affect different parts of the market at different times. Sometimes there's a lot going on and it's kind of confusing. Sometimes there's only a few things going on and it makes it a lot easier. So just point out two things here. One is Apple. Now, Apple is not just everyone's phone company or whatever. It's also the biggest stock in the market. This is between 7 and 8% of the S&P 500. So there's 500 stocks in the S&P 500, and this one stock accounts for 7%. So in the stock market or in any financial market, for that matter, some price levels are more important than others, and that's just how it is. Now, way back in August of last year, as you can see, Apple had this big move higher and it hit resistance there, right? And then it went lower, went back up, finally got above it. Now, what happens? A lot of the people that sold it back there regret selling it, and they tell themselves, hey, I'm going to buy my shares back if I can get them for the same price I sold them at. So you get these remorseful sellers who sold over here, placing buy orders over here. And if there's enough of them, the level that converts to support can turn into resistance. I'm sorry, I said it backwards. The level that was resistance can turn into support. So as we can see, this 174 level continues to be important for Apple, even though it's over a year later. This is what we call market memory. Sometimes these levels that are important, they can retain their importance for a long time. And I would be glad to show you. Just get in touch with me. Okay, so now here is the important thing. Because this is such an important level, it's pretty safe to say, if you ask me, the stock market is not going to go meaningfully higher as long as Apple is below 174, 175. And what could happen is the longer it stays under it, the more anxious sellers get because they notice, hey, the price is not moving higher anymore. What the hell is going on here? There must be a lot of other sellers around putting a roof on it or putting a ceiling on it. So I better get more aggressive and reduce the prices I'm willing to sell at. And that starts a snowball effect because other traders see that and they do the same thing. So number one, keep an eye on Apple and how it navigates this 174, 175 level. Number two is not going to surprise you is interest rates. This is the bond market is just in a free fall. And this is a result of deficit spending. The Fed and the Treasury or whoever, the Treasury is selling government bonds. And what does that do? That knocks the price down, but it makes the yields go higher. So up to 4.8%. As long as this is moving higher and Apple's below 174 level, I just have a hard time seeing stocks go higher, with the exception of energy stocks, because they're going to essentially follow oil. All right, next thing I want to talk about is if this keeps going up, utilities will probably still keep going down. So if you're an options trader, you can look into trading some options here, right? Because when you get a lot of, sometimes when you get off the popular stocks like Tesla and you go find some obscure utility, you could potentially get a much better price or a much lower premium. So this is like a free fall, right? I mean, it rebounded a little bit today, but considering the move lower it had, this is nothing. So what's going on here? Well, most people I don't know if I could say most, but a big part of the reason why people invest in utilities is because they get income. They get high dividends. If they can get better returns or better dividends or higher dividends in the bond market, they sell their utility stocks and they go buy bonds. So as long as those yields keep rising, there's going to continue to be pressure here on the utilities. All right, next thing I want to show you really quick is Novo Nordisk. This could be about to refill the gap, which means it could be going lower. So we saw that one of the reasons why we have support is because we have remorseful sellers trying to buy their shares back at the price that they sold them at. Well, when you gap, meaning you closed here on this day and you opened here on this day, there's no trading in between there. So if there's no trading, just by definition, there's going to be no one who sold who's remorseful who's going to be trying to buy their shares back. So this is why they say gaps refill. If we gap through prices one way, or gap through price levels one way, and then we eventually turn and get back to those price levels and start moving back the other way, there's not going to be a lot of vested interest in those price levels that we gap through. So we tend to make rapid moves lower. And as a matter of fact, one of my teaching lessons is about this very thing, gaps and fast moves. All right, just kind of end it off here. Just want to take a look at gold because there's just a lot of good lessons to learn here. Might be getting ready for a little bit of a bounce here. I don't know if it's going to be anything too insane, but this kind of illustrates the principle I was just talking about. Now, this isn't a gap, but notice how we move fast through these price levels, and then we move fast when we get back to them, right? So we move so fast, there's not a lot of time for there to be a lot of sellers who are concentrated around a particular price saying, I'm going to buy my shares back. So when the sellers come in, they have a hard time finding buyers. So this is our example of fast move up, reversal, fast move down. We also see here a descending triangle pattern, these are pretty reliable patterns. I don't really look at a lot of patterns, but what this shows is you got your support down here. These are your buyers, and they're hanging out. Like they're like, just, yeah, whatever. If the seller's coming to me, I'll buy. If not, I don't care. They're staying at the same price, but the sellers are getting more aggressive. They're willing to take lower prices. And that shows up as these, what we call lower highs. When a peak forms at a lower level than the prior peak, we call that a lower high. And that tells us that the sellers are getting more aggressive, meaning they're willing to accept lower prices. So this combination of complacent or patient buyers and aggressive sellers usually shows us that there's going to be a move lower. And we could see here, right, just some great examples of, before I get going, support here becomes resistance. So you got people who bought here, price goes lower. They say, I'm going to get out if I can at my price I bought at, so I can get out of break even. Gets back up to the level that was support, and it becomes resistance. Now here we got resistance turning into support. This is because of seller's remorse. There's people who sold here, the price goes lower, the price goes higher. And then a lot of them say, damn, I shouldn't have sold. I'm going to buy my, in this case, gold back if I can, the same price I sold it at. So resistance can turn into support. So when you're looking at charts, you got to look at them through the prism of what does this tell us about investment psychology and trader psychology and so forth. Okay, everyone. Thank you so much. And I will see you soon.